Guys, in this lesson, I will explain how to make full use of our utility. These will be all possible variations of averaging. The first is basic averaging. The second is ladder style averaging, which is also known as the ladder method. And the third is Martingale style averaging. This is risky management, just to warn you. It is not necessary to use it. The previous trading styles, basic styles, where you make just one trade, are quite sufficient to make a good profit. But if you want quick results, then averaging is exactly the effective tool you need.
So, now let's analyze what averaging is. With the pumping utility tool, basic averaging can be applied, meaning without increasing the trading lot, ladder averaging, especially when the trading lot increases, and martingale averaging, when we average according to a special formula. Now I will explain everything. So, basic averaging. In the previous lesson, we talked about how quotes move in waves, right? And from this theory, all those who average their trades base their strategies. I will describe how it works in much greater detail. Let's take the currency pair, British pound against Singapore dollar, as a specific example. Here we received a buy signal, which indicated a good opportunity to enter the market. And here we have the level at which we made this trade, which was carefully chosen based on our analysis. And here, our indicator gave a signal to close, which is a rather pointless signal that does not provide any useful information. This is a secondary signal that I mentioned earlier. We do not use it because it lacks reliability and consistency. We always close trades at the red level, the average level of the sigma channel. This closing approximately did not happen, right here. Minus 15 points, a small loss, which is unpleasant. And what I would suggest doing here is that we see that before closing here, or rather before reaching this quote level, it went down by 75 points. If we had made a new trade here, then we would have had a loss of minus 17 points on one trade, while on the other trade, pulling it here to the closing level, there would have been a profit of 54. This means that the market movement was quite significant, and understanding these fluctuations is crucial for making informed trading decisions. By analyzing the drop of 75 points, we can see the potential risks involved. The loss of 17 points on one trade highlights the importance of timing and strategy. Conversely, the profit of 54 points on the other trade demonstrates the potential for gains if the market is navigated correctly. Therefore, it is essential to consider these factors when planning future trades to maximize profits and minimize losses. Point 54 minus 17. We understand that from these two trades combined, we would have made a profit. Let's take another one. Let's take another, more complex option. Here we received a sell signal, meaning trading down, and we went down 240 points before starting to decline. The quotes rose by 240 points upwards before they finally decreased. This movement is significant as it demonstrates the volatility and unpredictability of the market, which traders must always be prepared for. Understanding these fluctuations can help in making more informed trading decisions. Let's imagine that we would enter a trade approximately every 80 pips. We set it up in the settings. I will explain later how everything is configured in the utility. We have set it up, the utility will average trades every 80 pips. That is, for example, right now. For example, starting from the opening level of the trade, we take the first level and set it here. This is where we would initially start the first trade. We add approximately 80 points, which is approximately here, and then we add another 80 points here. With such trades spaced evenly apart, we proceed further and close in profit. Here in the settings, we will set the smart closing with the final time frame H4 for smart closing, and we will go and look at the details. I won't skip through each time frame. I will say that we will have a closing at H4 here, and so at the red level, H4, which is crucial for our analysis. Now we will start counting from this, from the first trade at the closing level, ensuring accuracy in our calculations, and make sure we understand the implications of each step. We will draw one line from this trade and another line from the next trade from this level to visualize the trend clearly and ensure that we are following the correct procedure. The third, in essence, as if we are extending from commercial trades to the level of profit fixation. So, now let's calculate right now. Several signals simultaneously, at once. That is, while I am explaining right now, we could trade and make a profit, but don't rush. Watch this course until the end, after which we will definitely start trading. So, here we have a loss of 80 points. Here at 0, here at the beginning, the profit is approximately 80. And here the average profit is in total 160. From 160, we essentially subtract 0. This is the trade. It results in about 160, and subtracting approximately 80 gives us approximately 80 points. Thus, we have turned this losing trade into a profit of 80 points. And so, in principle, you can turn every losing trade into a mega profit. The one condition to remember is that the size of your capital must be sufficient to execute not just one trade, but rather 3, 4, or 5 trades on a single asset. Thus, you should have more capital in your account than the minimum recommended in order to safely and securely maintain a healthy balance. For example, if we recommend starting with $1,000 for regular trading, for regular safe basic trading, this is for comfortable trading. The minimum amount for basic trading is $200. A comfortable amount could even be said to be not 1,000 but 500. Well, 1,000 would be just right. That would be great. In order to trade using the basic averaging strategy without increasing the lot size, it is essential to have a minimum of $3,000 available in your trading account to ensure you can manage potential losses and maintain your positions. As for the setup of averaging, typically, generally speaking, here's what we do. We set the time frame for starting at M15. This is the starting time frame that I recommend everyone to begin trading with. The time frame for the smart closing of H4. Set the finish level, sigma to 3, set the trading lot to the minimum. Then we will return to money management and you will be able to change it. Now we will analyze all examples on the minimum time frame of 0.01. Here, only profit. And here is the step for averaging. We need to set that step, which we remember we said would be every 80 points, or every 90, or every 100. Set here 100 points, which is 1,000 pips. We talked about points in terms of points. We trade on 5 digits, so here it will be pips, which will be 1,000. Set 1,000 for now, this will be 100 points. Set the multiplier to 1, so that the size of the trading lot does not increase. Here, false, meaning we turn it off, and here, accordingly, the value will also be turned off. This is how you need to set it up to average every 100 points and close the final results with a profit at a profitable level. But the final time frame for closing will be H4. That is, even in this case, if everything goes wrong and the market is moving somewhere, we will still close even several of these trades, even at a loss. But at the red level, we will not let the profit go without a return, without a pullback, so that we can fully recover our deposit. We always have a fallback scenario, which is to close our trades on a pullback on the H4 time frame. Most likely, this will be a profitable closing, but if it results in a loss, it will be a small loss. Always set the finish time frame for smart closing on H4 and apply averaging while we set 100 points here. 100 points is 1,000 pips. We simply click OK. This way, after we just make a trade and it goes in the wrong direction. For instance, here we made trade A, specifically. Let's say we made a buy trade here. And before the price goes up, it would first go down by 200 points. Then we would activate the utility, which would add one trade first, then a second one, and when the quotes returned upwards. Instead of a small floating loss, you would have two healthy profits, two big profits. This is, for example, another variant of the example. Here I showed you, yes, you traded low on sell, but the price went up, 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 and you added here, here, here to the trade. And thus, when the price reversed, these several trades brought you a good big profit. And by the way, the price hasn't returned. You see, this gives us the opportunity, firstly, to close the trade earlier than the return, even before the level of the trade's opening. Because the price may not even reach there. You see, that's exactly what happened. The quotes didn't even return to this level. If we had traded with a single position, we would have closed on the H4 here with a small loss. And if we are trading with averaging, then here we have already closed with a profit. But be careful. I was saying, this is dangerous trading because firstly, you need to have more trades and a larger starting capital, and secondly, a good leverage. Now, regarding Martingale, or let's not start with that. First, let's take averaging with a ladder. Here, I showed you the basic settings for averaging. Now, if we want to average using a ladder, we click True and Set. The lot size that will be added to each subsequent trade. For example, if the first trade is 0.01, then the next one will be 0.02, the following one will be 0.03, and then 0.04. This means that each time an additional 0.01 will be added to the previous lot size. Here, 0.04 means that each time an additional 0.01 will be added to the previous lot size. This will be essentially averaging ladder. We will have it, basically, like a staircase with small steps. Thus, in essence, if we do 0.01 here, I will show you the lot size indeed in a way that will make it very much clearer for you. Let's carefully apply these lot values. Here, 0.02 exactly like this. 0.02 here, 0.03, 0.02. Here is 0.3. Here, 0.04, 0.04. Here we made a 0.01 lot size based on this sell signal. The price did not go down, contrary to everything, contrary to the indicator signal. No matter how precisely everything worked, the price went up. And here we incur a loss. The utility adds automatically. It will do this automatically, adding another trade with a lot size of 0.02, a bunch of 0.02 lot size. We will see a total lot of 0.01 plus 0.02, which gives us 0.03 lots already engaged. But the price is not showing signs of reversing and is moving upwards. The utility makes another trade of 0.03, bringing our total to 0.06 lots engaged, and the price continues to rise. Here, the utility adds another trade of 0.04. Thus, our trading lot size increases step by step. When the price eventually reverses and goes down, and we close this at, for example, a profitable level, where the utility identifies the first profit level, we will close this trade with a huge profit. The trades of 0.1 and 0.02 will incur a loss, with their total lot size being 0.03, while the total size of these two profitable trades will be 0.07. I won't spend time calculating how much this will be in points or money right now. You just need to basically understand that the size of two small trades with a lot size of 0.03 will essentially result in half the outcome compared to those two upper trades that we executed at the very top before the reversal. In fact, this is a crucial point to comprehend. Thus, ladder averaging will bring us even more profit than regular basic averaging. You can take a screenshot, or I can do it for you later and post it under the video, showing exactly what settings you need to make in order to trade using ladder averaging. Additionally, if you set the starting lot size higher, you can also increase the size of the ladder. For example, you can set your initial lot to 0.01 and then increase it by 0.02 with each trade. This means your first trade will be 0.01, the second trade will be 0.03, the third trade will be 0.05, and the fourth trade will be 0.07. This way, the intensity of the lot growth will be higher. Now, I will tell you about Martingale. It is a similar algorithm, but the formula is slightly different. Here we need to turn off this ladder averaging. Here, it doesn't matter. We can leave any value. And we set the multiplication factor, the increase factor, such as, for example, to the value of 2. Thus, each subsequent trade in this ladder averaging will be twice as large as the previous one. This is an explanation of how the process of averaging works in detail. Therefore, it is important to consider another signal from Fossil for a comprehensive understanding. Thus, you can trade using the basic function, which allows you to perform one trade at a time, or you can opt for one trade with smart closing, providing more control and efficiency. Then you can trade using basic averaging without increasing the lot, ladder averaging with lot increase, and martingale averaging. You already have about 5 trading options. All these options are profitable, some are risky, and some are super safe. In my next videos, I will show how each of them works with examples. But for now, let's continue our training. In the next video, I will explain how to calculate this value for averaging, what exact value to write here, because each currency pair has different volatility. One currency pair makes 100 pips a day, or even 200 pips a day, while another makes only 30. For example, AUD-CAD. Here is a currency pair. Australian dollar against Canadian dollar. It moves on average about 50 pips during the day. Well, not a maximum, but 50 pips on average. And Euro UD makes 150. That is, for these currency pairs, we use completely different sizes that we set here. The size for averaging stop were exactly right here, precisely. That is, you can set 300, or you can set 500, or you can set 1500. And for different currency pairs, this will be a completely different value. I will show you how to calculate this in the next lesson. And only after that, we will get to trading, and I will show you how to make trades. We will now go into more detail about how to close signals and how to use all of this in practice. Right now, we are only discussing the theory. In the next lessons, we will get closer to practice. Let's meet again in the next lesson. Goodbye for now.